Welcome to our comprehensive guide on how the stock market works and how you can profit from it. Whether you're a beginner or looking to refine your investment strategy, this video will break it all down. By the end, let's dive in with a simple question. What is the stock market? The stock market is a collection of exchanges where shares of publicly traded companies are bought and sold. Think of it as a marketplace, like a digital supermarket, but instead of groceries, you're trading ownership in companies. Major exchanges include the New York Stock Exchange, or NYSE, and the Nasdaq, both based in the United States. There are also global exchanges like the Tokyo Stock Exchange and the London Stock Exchange. These platforms connect buyers and sellers, ensuring trades happen smoothly and transparently. When you buy a stock, you're purchasing a small piece of a company, also known as a share. This share represents partial ownership, and its value can rise or fall based on the company's performance. The stock market exists to help companies raise money and let investors share in their success. Companies sell shares through an initial public offering, or IPO, to fund growth or operations. Once shares are issued, they're traded on exchanges in what's called the secondary market. This is where most investors, like you, buy and sell stocks to make a profit. Now, let's talk about why stock prices move up and down. Stock prices are driven by supply and demand, just like any other market. If more people want to buy a stock than sell it, the price goes up. If more people are selling than buying, the price goes down. This dynamic is influenced by a variety of factors, both inside and outside the company. Company performance is a big driver. Strong earnings reports, new product launches, or good management decisions can boost a stock's price. On the flip side, poor earnings, scandals, or product failures can cause prices to drop. Economic indicators also play a huge role. Things like interest rates, inflation, and GDP growth affect investor confidence. For example, when interest rates rise, borrowing costs increase, which can hurt company profits. This often leads to lower stock prices as investors sell off shares. Market sentiment, or how investors feel about the market, is another key factor. Optimism can drive prices up, while fear or uncertainty can push them down. Global events, like political changes or natural disasters, can also shake things up. For instance, trade tariffs announced in April 2025 have created uncertainty, impacting stock prices. Understanding these factors helps you predict price movements and make smarter investment choices. So, how do you actually make money in the stock market? There are two main ways: capital gains and dividends. Capital gains happen when you sell a stock for more than you paid for it. For example, if you buy a stock at $10 and sell it at $15, you've made a $5 profit. Dividends are payments some companies make to shareholders, usually from profits. These are often paid quarterly and provide a steady income stream. Not all companies pay dividends, but those that do, like blue-chip stocks, are popular with investors. To profit, you need a strategy, and there are several approaches to choose from. Let's explore some of the most common investment strategies. First up is buy and hold investing. This is a long-term strategy where you buy stocks and hold them for years, even decades. The idea is to invest in strong companies and let their value grow over time. Historically, the stock market has delivered average annual returns of around 10%. This makes buy and hold a reliable way to build wealth, especially for retirement. Another strategy is value investing. Value investors look for stocks that are undervalued compared to their intrinsic worth. These are often companies with strong fundamentals but low price-to-earnings ratios. The goal is to buy these stocks cheap and sell them when the market recognizes their true value. Famous investors like Warren Buffett have used this approach to amass fortunes. Growth investing is another popular method. Here, you focus on companies expected to grow faster than the market average. These are often tech startups or innovative firms with high potential. Growth stocks may not pay dividends, but their stock prices can soar if the company succeeds. However, they're riskier, as high expectations can lead to big losses if growth stalls. Then there's dividend investing. This strategy involves buying stocks that pay consistent dividends. You earn regular income, which can be reinvested to buy more shares. Over time, this compounding effect can significantly grow your wealth. Finally, there's active trading, including day trading and swing trading. Active traders buy and sell stocks frequently, aiming to profit from short-term price movements. This approach requires skill, time, and a high tolerance for risk. It's not for everyone, as many traders lose money due to market volatility. No matter your strategy, diversification is key to managing risk. Diversification means spreading your investments across different companies and industries. This way, if one stock or sector performs poorly, others may offset the losses. For example, you might invest in tech, healthcare, and energy stocks to balance your portfolio. You can also diversify by including other assets, like bonds or real estate. One easy way to diversify is through index funds or exchange-traded funds, known as ETF. These funds pool money from many investors to buy a basket of stocks. For instance, an S&P 500 index fund invests in the 500 largest US companies. This gives you exposure to the entire market with a single investment. Index funds are popular because they're low cost and reduce the risk of picking individual stocks. Now let's talk about how to get started with investing. The first step is opening a brokerage account. A brokerage account lets you buy and sell stocks through an online platform or a broker. Popular brokers include Charles Schwab, Fidelity, and Robinhood. Many offer low or no commissions, making it affordable to start investing. You can also use robo-advisors, which are automated platforms that manage your investments. Robo-advisors like Betterment or Wealthfront are great for beginners. You don't need a lot to begin. Many platforms let you start with just a few dollars. Next, decide how much you can invest regularly. A strategy called dollar cost averaging can help you invest consistently. This means investing a fixed amount at regular intervals, regardless of market conditions. It reduces the risk of buying stocks at a high price and helps smooth out returns. Before you buy any stock, do your research. Look at the company's financials, like its revenue, profits, and debt. Check its annual reports and prospectus, which are filed with the SEC. You can also read analyst reports or news about the company's industry. Websites like Yahoo Finance or Morningstar offer free data to help you analyze stocks. Be cautious of hot tips or hype on social media, as they can lead to poor decisions. Once you've chosen a stock, place a trade through your brokerage account. You can use a market order to buy at the current price or a limit order to set a specific price. After buying, monitor your investments but avoid checking them obsessively. Market fluctuations are normal, and short-term dips don't always mean you should sell. Focus on your long-term goals and stick to your strategy. Let's talk about some risks you should be aware of. Investing in stocks always involves risk, as prices can drop unexpectedly. You could lose some or all of your investment, especially with individual stocks. Market crashes or bubbles, like the dot-com bubble, can wipe out gains. Psychological factors like fear or greed can also lead to bad decisions. For example, panic selling during a dip can lock in losses you might have avoided. To manage risk, never invest money you can't afford to lose. Keep an emergency fund separate from your investment account. Also, consider setting stop-loss orders to limit losses on individual stocks. These automatically sell a stock if it falls below a certain price. Another risk is inflation, which erodes your purchasing power over time. Stocks generally outpace inflation, but it's still a factor to consider. Taxes are another consideration. Profits from selling stocks are subject to capital gains tax. In the US, long-term gains from stocks held over a year are taxed at a lower rate. Short-term gains from stocks held less than a year are taxed as ordinary income. Dividends are also taxed, either as ordinary income or at a lower rate for qualified dividends. Consult a tax professional to understand how taxes affect your returns. Now, let's look at some advanced strategies for profiting in the stock market. One is short selling, which lets you profit when a stock's price falls. Here's how it works. You borrow shares and sell them at the current price. If the price drops, You buy the shares back at a lower price and return them. The difference is your profit, but short selling is risky and not for beginners. Another advanced method is options trading. Options are contracts that give you the right to buy or sell a stock at a set price. They can amplify returns, but also come with high risks. You need a solid understanding of the market before diving into options. Technical analysis is another tool used by active traders. This involves studying price charts and patterns to predict future movements. Indicators like moving averages or relative strength index can guide decisions. While useful technical analysis isn't foolproof and requires practice, let's discuss some current trends affecting the stock market in 2025. Trade tariffs have been a hot topic, creating volatility in global markets. For example, recent U.S. tariff proposals have impacted sectors like automotive and technology. Investors are cautious, as tariffs can raise costs and hurt company profits. On the positive side, domestic and value-added companies may benefit from reduced foreign competition. Another trend is the rise of artificial intelligence and green energy stocks. Companies innovating in AI or renewable energy are attracting significant investment. However, these sectors can be volatile, so thorough research is essential. Interest rates are also a major factor in 2025. The Federal Reserve's policies influence borrowing costs and stock valuations. If rates stay high, growth stocks may struggle, while value stocks could shine. Keep an eye on economic reports to stay informed about rate changes. Finally, let's wrap up with some practical tips for success. Start small and invest only what you can afford to lose. Focus on learning rather than chasing quick profits. Read books like The Intelligent Investor by Benjamin Graham for timeless advice. Join online communities or forums to learn from other investors. Consider working with a financial advisor if you're unsure about your strategy. Stay disciplined and avoid emotional decisions based on market swings. Review your portfolio regularly to ensure it aligns with your goals. And most importantly, be patient. Wealth building takes time. The stock market is a powerful tool for growing your money. But it's not a get-rich-quick scheme. With knowledge, strategy, and discipline, you can profit and achieve your financial goals. Thanks for watching this guide on how the stock market works and how you can profit. If you found this helpful, give us a thumbs up and subscribe for more financial tips. Leave a comment with your questions or share your investing journey. Until next time, happy investing.